When I first entered this business, the hardest truth I had to face was this. The market doesn't owe me anything. It doesn't care what I think, what I believe, or what I want. The market simply reflects the collective behavior of millions of participants, nothing more. My opinions, no matter how logical they sound, don't move price. The only thing that moves price is the flow of orders, the expression of mass psychology. And once you truly accept that, you stop fighting the market. You stop trying to be right and start learning how to be consistent. That's the difference between the novice and the professional. The novice argues with price because he still believes his analysis should matter more than the market's verdict. But the professional knows. Arguing with price is arguing with reality. And reality always wins. You can take 1,000 trades and make no progress if you don't accept one simple principle. Cut your losses short and let your profits run. It isn't a slogan. It's the logical result of understanding probability. Every trade has an uncertain outcome, and your job is not to predict it. Your job is to manage it. A small loss is not a failure. It's simply the cost of discovering that this trade wasn't the one that would move in your favor. It's the price of staying in the game long enough for probability to play out. Letting profits run is the other side of that truth. Because the big money, the money that transforms accounts and careers, doesn't come from being right often. It comes from letting the winners express their full potential. You can't know how far a trend will go. You can only ride it as long as the market continues to confirm your position. Think about this. How many times have you seen a trade move in your favor only to close it quickly out of fear that you'll lose what you've gained? That's not risk management. That's emotional management gone wrong. Most traders live in fear of giving back profits because they're still attached to the outcome of each trade. But trading isn't about individual trades. It's about the series of trades. Reverse your emotional wiring, and you'll begin to think like a consistently profitable trader. Objective, detached, calm. Few people can truly do this, which is why most never make it. I used to believe I could outthink the market. That if I studied hard enough or watched price long enough, I could force it to obey my logic. You ever felt that? You put on a position, and suddenly you're hoping instead of observing. You want the market to move because you need it to, but the market doesn't respond to your needs. It only reflects behavior. It punishes attachment and rewards acceptance. That's why I say, cut losses fast, clean, without hesitation. If the market proves you wrong, accept it immediately. Every tick against you is information, not injustice. Something's off. Maybe the setup failed. Maybe conditions shifted. It doesn't matter why. What matters is that your edge didn't play out this time. A small, controlled loss today is just data. A large emotional loss tomorrow is destruction, not only of your account, but of your confidence. And once confidence goes, your edge becomes meaningless. Holding winners, though, that's where discipline transforms into mastery. Most people can take a loss once, but can they sit through uncertainty day after day while their winner fluctuates? Every retracement feels like the market is stealing your gains. Every headline shakes your nerve. That's why holding a winner is psychologically harder than cutting a loser. It takes belief, not belief in the trade, but in yourself. Belief that you can stay objective in a field designed to trigger every human weakness. When I look at price, I don't see random ticks. I see the psychology of the crowd in motion, fear and greed righting themselves in real time. When a market breaks out on volume and holds those gains through pullbacks, that's not just a pattern. That's confirmation that belief is spreading. And if the flow confirms your edge, why cut it short? The amateurs sell for crumbs. The professionals hold for trends. Every trader must decide, are you here for excitement or for consistency? Because those two goals lead to completely different destinations. The thrill seeker craves action, but the consistent trader craves alignment. Alignment with the market, not with emotion. Back in my early days, I thought quick profits were the mark of skill. I'd spot a move, jump in, take a small gain, and feel clever. But clever doesn't compound wealth. Discipline does. The real edge comes from catching those major moves, the ones that test your patience and conviction. That's when let your profits run becomes a mindset, not a motto. I remember once I caught a strong trend. I made a few points and got nervous. I closed the trade, proud of myself for locking in profit. The next week, the same move I abandoned tripled without me. That experience taught me something deeper than any book could. The pain of missing what you could have had because of fear is sharper than the pain of loss. From that day, I promised myself to act from probabilities, not emotions. Because in truth, every trade outcome is uncertain. You never know which one will be the big one. Your only edge is consistency of execution, following your process without emotional interference. Think about it. Cutting a loss takes courage once. Holding a winner demands courage every day. Every fluctuation whispers to you to quit. Every piece of news tempts you to doubt. But can you hold steady, trusting that your process is more powerful than your feelings? That's the mark of a professional. Charts don't tell you the future. They reflect what is. When you see weakness, lower highs, fading volume, loss of momentum, that's your signal, not your fear. You exit not because you feel like it, but because your rules say so. Discipline, not desire, is your weapon. And that same discipline governs your money management. Risk small enough to survive multiple losses because losses are inevitable. The key is staying in the game long enough for your edge to express itself. Small losses keep you alive, large ones take you out. Consistency is built from accepting randomness. It's about execution, not prediction. You can't control outcome, only process. That's why emotions are the real enemy. They'll beg you to hold a loser, promising it'll turn around. They'll whisper to take quick profits, convincing you that safety lies in small wins. But emotions have no statistical edge. Your rules do. When I made my fortune, people asked for my secret. But there was no secret, just unwavering adherence to principles. I accepted uncertainty, managed risk, and followed my plan. I cut losses instantly and held winners until the market itself told me to exit. Sounds simple, doesn't it? Yet almost no one does it. Why? Because most traders are fighting not the market, but themselves. They can't stand to be wrong. But in this business, being wrong is part of being right in the long run. Cutting a loss is not failure. It's alignment with probability. The market doesn't punish mistakes. It punishes ego. And the trader who can't cut a loss is ruled by ego, not by discipline. A losing position doesn't know you exist. It doesn't care about your hopes or your cost basis. It simply moves. If you cling to it, you're attaching meaning where there is none. That's not trading, that's denial. Every dollar trapped in a losing trade is capital stolen from opportunity. When you cut a loss, you free energy, attention, and capital to re-enter with clarity. That's not defense, that's strategy. And when you let profits run, you don't just build wealth, you build trust in yourself. You learn that you can stay calm through noise, that you can act from process, not impulse. That trust is worth more than any single trade, because it makes you a consistent trader. The greatest fortunes in markets were never made by those chasing excitement. They were made by those who learned to surrender, to let go of control, to flow with the probabilities. If you can't cut losses, you'll drown in denial. If you can't let profits run, you'll starve from fear. The market is impartial, ruthless but fair. It gives everyone the same opportunity. Follow the laws of probability and discipline, or fall to emotion and ego. Losses are not punishment, they are tuition. Small fees paid for the privilege of playing the game tomorrow. Big losses take you out. That single truth holds more weight than all the forecasts, opinions, and predictions you'll ever hear. Every trader who has endured long enough to survive in this business has paid that price. You can't avoid it. You can't negotiate it, and you can't outsmart it. The only choice you have is whether you'll pay in small, controlled amounts as part of learning, or pay so much in one blow that you're forced to walk away. Think about it. In any other field, you invest in education, training, tools, and experience before you ever expect mastery. Why should trading be different? The market is the most honest teacher in the world, but it charges tuition in uncertainty and losses, and it charges without sympathy. When I first started, I didn't understand this. I resisted every loss as if the market were insulting my intelligence. I saw each losing trade as a personal attack, a judgment on my worth. But the market wasn't attacking me. It was reflecting me. It was showing me my resistance, my pride, my need to be right. The problem was I didn't want feedback. I wanted validation. I wanted to prove I knew what I was doing. And that need to be right is the costliest belief a trader can hold. Small losses are not enemies. They are neutral feedback. They are information about where your expectations no longer align with reality. When you place a trade, you're not proving anything. You're simply expressing a probability. And probabilities don't require you to be right. They require you to think in terms of risk versus potential. If a business owner pays rent, does he curse the landlord every month? Of course not. He accepts it as a necessary expense. A trader must treat small losses the same way, as rent paid to stay in the game. Every loss is an operating cost for doing business in uncertainty. Yet how many traders think this way? Most take losses personally, interpreting them as rejection. And so they hold on, hoping the market will reverse and restore their ego. But that's not trading. That's emotional bargaining. And in the market, every bargain with emotion comes with interest. Here's a truth. You don't lose because you're wrong. You lose because you stay wrong. A trade that doesn't work out quickly is harmless if accepted. But a trade you cling to, that you justify and defend, becomes a wound that drains confidence. Small losses teach flexibility. Big losses demand emotional recovery. The reason small losses are tuition is because they teach the only lesson that matters. You're not here to be right. You're here to think objectively. The trader who needs to be right every time will crumble under pressure. The trader who knows he will be wrong often, but wrong small, will thrive. Big losses don't just destroy capital. They damage your ability to trust yourself. You can rebuild money faster than you can rebuild confidence. After a major drawdown, many traders begin to hesitate on high probability setups. Or they overtrade in revenge, or they abandon rules entirely, desperate to win back what they've lost. Have you ever seen a trader double down after a loss like a gambler chasing his luck? That's what happens when emotion replaces probability. The only true prevention is never letting a loss become large in the first place. Small losses sting, but they don't scar. Big ones leave marks that influence every decision after them. I remember early in my journey holding a losing position that contradicted every signal I used. Every instinct told me to exit, yet I rationalized staying. I told myself the market was wrong, that I just needed more time. Days turned into weeks, and the position grew heavier until I couldn't face the screen. When I was finally forced out, I realized the loss wasn't just financial. It was psychological. I'd broken my own trust. That's when I understood the essential truth. Cut the loss when it's small, or it will cut you when it's large. The math is simple but profound. Lose 10% and you need 11% to recover. Lose 50% and you need 100% just to break even. That's why every experienced trader protects against the large loss, not because of the numbers, but because of the psychological drag that comes with them. Big losses consume energy, focus, and belief. The market doesn't care about fairness, effort, or good intentions. It reflects behavior, not virtue. The only protection you have is discipline. The discipline to acknowledge invalidation quickly, pay the tuition, and move on without emotional residue. The interesting thing is this. Once you truly accept small losses as part of the game, they stop hurting. They become routine, like a pilot adjusting for turbulence, or a surgeon sterilizing instruments. You take the trade, you define the risk, and if the outcome falls outside your expectation, you close it calmly. No panic, no argument, just process. And that calm acceptance keeps you psychologically balanced. The trader who cannot accept small losses will never remain long enough to experience the big wins. That's the paradox. Look at every great trader in history. None avoided losses. Each accepted them as the inevitable cost of discovering what works. The difference was that they refused to let a single trade define their identity. Small losses built awareness, big ones ended careers. That's why small losses are sacred. They teach humility, patience, and respect for uncertainty. They remind you that success comes not from avoiding pain, but from managing it intelligently. When you treat small losses as tuition, you liberate yourself from the fear of being wrong. And when fear no longer controls you, you become capable of seeing the market as it is, not as you need it to be. Fear paralyzes. Acceptance empowers. Once you accept that losses are part of the process, you stop resisting feedback. You start focusing on executing your plan rather than avoiding discomfort. Discipline replaces prediction as your compass, and that's when consistency begins. The market is never wrong, only your expectations are. You can have the most rational argument in the world, but if the market disagrees, the market wins. The faster you accept that feedback, the cheaper the lesson. Refuse it, and the cost compounds. And believe me, the market is a ruthless accountant. It collects every debt. What happens when you finally integrate this truth? You detach. You stop tying your self-worth to each outcome. You no longer chase the thrill of being right. You pursue the satisfaction of staying consistent. You see each small loss not as defeat, but as confirmation that your process is alive, that you have the courage to act in alignment with uncertainty rather than emotion. And because you keep your losses controlled, you remain available, emotionally and financially, to seize the rare moments when the market aligns perfectly with your edge. Isn't that what every trader truly wants? To operate freely, without fear, with clarity and patience. The market doesn't care about your ego or your dreams. It only responds to discipline and emotional neutrality. Cutting losses is the first and purest form of discipline. Accept them, even appreciate them, because they prove you've mastered what most traders never will. detachment. As long as you're willing to learn, you remain in the greatest psychological classroom in the world, the market itself. Cutting losers frees capital, and capital is not just money, it's potential. Yet most traders violate this truth daily. They anchor their resources in weak positions and wonder why they can't capture strength. Every dollar trapped in denial is a soldier removed from opportunity. Think of your capital as energy. If you waste it defending the losing side, you can't deploy it where the probabilities favor you. When you refuse to cut, you don't just lose money, you lose flexibility. You become emotionally and financially paralyzed, waiting for a market pardon that may never come. Remember, the market owes you nothing. It doesn't reward loyalty, and it doesn't recognize attachment. A stock doesn't know you own it. It only reflects mass perception. The moment you realize that, you stop treating positions like relationships and start treating them like probabilities. Capital must move toward opportunity, like water flowing toward gravity. When you release it from stagnation and redirect it toward strength, you allow growth. That's how wealth is built, by aligning your capital with vitality, not with hope. Every market has leaders and laggards. The leaders break out with conviction. The laggards drag, full of hesitation. If your money is stuck in weakness, you're missing strength. And strength is where your edge lives. Cutting losers isn't just defense, it's expansion. You can't hold decay and reach for growth at the same time. You must choose, and that choice, made consistently, defines your longevity. I've sat in losing trades that drained energy and attention, watching opportunity sprint away on the same screen. I wasn't trapped by the market. I was trapped by my own refusal to accept loss. When I finally learned to free that capital, everything changed. Cutting losses isn't just a financial act. It's an act of psychological freedom. By the time I finally gave up, the leading stock had already doubled. What remained wasn't just the loss, it was regret. That sting was sharper than any drawdown could ever be. It wasn't the money I lost. It was the opportunity cost of mental attachment. That's when I swore I'd never again let emotional bondage to a losing trade keep me from seeing a winning one. Have you ever felt that? The dull ache of watching a clear winner unfold while you're still tied to a position you hope will recover? That's the real cost of attachment, not just in capital, but in attention. When your focus is locked on a losing trade, your awareness collapses. You become consumed by the need to fix, to be redeemed. You stop observing objectively. Meanwhile, the market continues presenting new, high-probability opportunities right in front of you, but you can't see them. Why? Because your mind, not just your money, is trapped. The longer you stay attached, the narrower your perspective becomes. That's why cutting losses isn't just a financial action. It's an act of mental freedom. It releases the energy tied up in defense so you can redeploy it into observation. Trading is as much about clarity of perception as it is about clarity of analysis. Capital follows clarity. Strong trades, the ones that align with flow and structure, tend to reward the energy and capital that move with them. Weak trades drain it. This is not mystical. It's simply the law of alignment. The professionals, the consistent winners, they don't waste time arguing with weakness. They constantly reallocate. They push their capital and their attention toward strength, toward alignment. That's why they seem to always be in the right place at the right time. Not because they predict, but because they flow. Meanwhile, most traders stay loyal to stagnation. They hold the weak positions and wonder why their accounts never grow. That's not loyalty. That's resistance. The market doesn't reward resistance, it rewards adaptation. Think about compounding, not just financial compounding, but psychological compounding. A dollar stuck in a dead position earns nothing, but a dollar and a mind committed to a high probability move can multiply. Over time, the difference becomes massive. One trader compounds awareness and returns. The other compounds frustration and inertia. One releases energy to follow flow. The other clings to what's decaying. Which trader do you want to be? Each time you cut a losing position, you reinforce discipline. You remind yourself, my capital is not a hostage to my emotions. You strengthen belief in your ability to act without hesitation. That act, that moment of aligned decision, is a small victory over fear. And every time you redirect that freed capital into a trade that reflects strength, you're stacking probability in your favor. Because your job is not to control the market. Your job is to keep your capital working in harmony with it. Many traders say, I can't sell now. I don't want to lock in the loss. But the truth is, the loss already exists. The moment price moves against your plan, it's there. Refusing to acknowledge it doesn't erase it. It compounds it. While you hold, your capital and your awareness are locked away. You're like a craftsman refusing to use his best tools because he doesn't want to admit one broke. Would any true professional do that? Then why do traders do it with their most vital tool, capital? Capital must be treated as sacred. It's your inventory, your creative energy, your means of expression in this uncertain environment. To trap it in weak, low-probability trades is to dishonor the very resource that sustains your growth. Freeing it and reallocating it to strength isn't emotional. It's intelligent. It's not enough to avoid losing. You must pursue alignment with winning behavior. And you can't do that if your capital or your mind is tethered to losses. Some traders say, but what if I sell and the market comes back? My answer is simple. So what? If the setup realigns with your plan, you can always re-enter. The market will never stop giving opportunities. The key is having the flexibility, emotional and financial, to take them. Would you rather step off early and pay a small fee, or ride a sinking ship because you can't bear to be wrong? Each small exit increases flexibility. And flexibility is life in trading. It allows you to pivot when the environment shifts, to move with the tide instead of against it. Flexibility is freedom. A trader with capital, both mental and monetary, has options. A trader without capital is stuck in hope. That's why I always say, cutting losses frees capital, and capital is freedom. Freedom to act, to think, to see clearly. In the end, only strong trades matter. Those aligned with flow, direction, and probability. But before you can ride strength, you must preserve the ability to act. Survival comes before success. Defense before offense. That's the rule that separates the consistent from the casualty. The average trader believes the goal is to find the one big winner, the home run that will change everything. But professionals know your first task is survival. You can't win if you're not still standing. Defense is the foundation. Offense is the expansion. Without one, the other collapses. Think of the market like an ocean. You can't sail it without knowing how to survive its storms. Defense is your hull, your structure. It keeps you afloat when volatility crashes. Offense is your sail. It captures the wind when the environment aligns. But what use is a sail if the hull is cracked? You'll never reach your destination. That's why defense, risk control, position sizing, emotional stability comes first. You limit exposure, you cut early, you protect capital. You recognize that the market will still be here tomorrow, and your edge can only express itself if you are too. Offense, by contrast, is expression, pressing advantage when you're in sync with the trend, scaling into confirmation, letting profits expand as the market rewards structure. But you can't press what you haven't protected. You can't attack without something left to attack with. I've watched traders with brilliant analysis fall apart because they never learned defense. They could read price action flawlessly, but ignored their own psychology. They'd over-leverage, double down, or hold through denial, and when the market turned, as it always does, they were finished. Not because their method failed, but because their mindset did. Meanwhile, traders of average intelligence but exceptional discipline endured. They survived the storms because they respected risk, and because they survived, they thrived. Which would you rather be, the genius who flames out or the disciplined survivor who compounds steadily? Survival isn't glamorous. Nobody boasts about the trades they cut for small losses. Nobody celebrates the quiet patience of wading through noise. But that's the essence of mastery, the unseen act of restraint that makes all visible success possible. The crowd admires the offense, the home runs, the streaks, the profits. But offense is built on the invisible layer of defense. Only those who protect their capital, their confidence, and their clarity will still be standing when the market aligns for a real run. The market will always offer another wave, another expansion phase, another opportunity. The question is, will you still have your capital and your composure when it comes? True wealth in this game is built through quiet survival followed by bold participation. Think of a boxer. He doesn't swing wildly, hoping to land one lucky hit. He spends most of his time guarding, reading, and waiting. His defense keeps him alive long enough to see the opening. When it appears, he strikes with precision. Trading is identical. Reckless offense without defense is chaos, but defense without offense is stagnation. The balance between the two, restraint and aggression, patience and action, is where mastery lives. Many traders mistake movement for progress. They think being active means being productive, but constant action without structure is just noise. The disciplined trader knows that sometimes not trading's the highest form of trading. Waiting is part of defense. Capital preservation isn't just avoiding losses. It's preserving your ability to recognize and act when opportunity arises. Every unnecessary loss weakens your position, financially and mentally. The tragedy is not losing. It's being too depleted to take the next great opportunity when it comes. Defense keeps you capable. Offense creates expansion. But without defense, offense is impossible. Emotional survival is just as critical as financial survival. A massive loss destroys not only your equity, but your mindset. You lose confidence, clarity, and the ability to act from objectivity. That's why consistency begins with emotional control. Small, controlled losses are not trauma. They're structure. They protect your mental equilibrium. They keep you in the zone. Defense of the mind is defense of the account, and without both, there is no longevity. Growth, the offensive phase, only begins after defense has done its job. Once your capital is secure and your mind is calm, then and only then can you press. You can add, you can scale, you can ride. Offense without defense is gambling. Defense without offense is stagnation. But together, they form consistency.